Good morning or good afternoon, wherever you are at. Let me know if you can hear me loud and clear. Getting everything going here real quick. Have to bear with me. I'm a little under the weather right now. Okay, looks like the mic's on. All right. Thank you, Andrew. Awesome. That's good. I had to get not my coffee, but get some other hot lemon water in case my throat gets crazy on me. I wasn't feeling that great last night for Trade U, but powered through it and it wasn't too bad. But I woke up this morning feeling really bad, and it's thankfully in the last 3 or 4 hours it's worn off. So I'm feeling a lot better at this moment in time. So we should be relatively normal. I might cough up a lung a little bit, but I'll try to mute it if need be. So, oh, sorry, Brenda, you can't see the kitty. She's up there in her perch. We got that new background on there though. So anyway, welcome out to Trading Coach's Playbook. Let's get the disclaimer out of the way. I'm not a registered broker dealer investment advisor. I'm not going to give you any recommendations or advice. Everything we do here is purely for educational purposes. If I do happen to mention a trade, just assume it is a paper trade or practice trade. For regulatory reasons, we do not discuss funded trading here. So here's all the events coming up in the next little bit, usually next week or two. Premium workshops, got Inner Circle, 24th, 25th, and 27th, Mastermind, 28th and the 4th. Market Movers, October 29th. Patterns in a Flash Q&A with yours truly, November 6th. Power Hour is every Monday at noon. Trading Coaches Playbook, this one every Friday at noon. And then Futures Trading Simplified with Brandon, October 29th and 30th. And then, of course, you got Power Option Plays every Monday and Thursday. Covered Call Explorer every Thursday with Trip. And then Brandon's E-Mini Think Tank every Monday, Wednesday, and Thursday. So we have to turn that off like usual, right? Pretty rare that I actually remember. Looks like all the we got this cousins thread, and when one of them starts going, it's anywhere from 15 to 20 or 30 texts a day. So it can be pretty active. The phone can blow up quite a bit when that happens. So got to mute it for now because they're talking about football or something. There is all the social media platforms that we're on. So go follow us on whichever ones you're on there. And then if we haven't met, these are the things I have, Patterns of Flash, which is all about charts, right? It's all about patterns, obviously, which are pretty important to know when it comes to trading. Not pretty important, they're paramount. So that's what the whole tool is designed to do, is get you from wherever you're at now to recognizing patterns quickly and easily, and how to use them, how to trade them. So, and it's not necessarily just patterns, but just technical analysis in general. Because if you don't understand the basics of technical analysis, then understanding the patterns is it can be done. It's just a lot harder. If you understand the foundational information, then you'll understand the patterns very easily. So, and honestly, that the whole thing came together backwards. Because the way I learned when I started back in 2000 was from books. Back then, we didn't have the ability to do what we're doing now. There was no online classes. The internet was just in its infancy. So you went to a live workshop or you read a book. That was about it. There's a few people out there that recorded videos and put them on VHS tapes, but that was expensive back then, so not many people did it. Now anybody with a $20 webcam and a computer can create whatever you want, pretty much. So, uh, but the one thing I ran into was that reading books, I started studying patterns. I could see the power of them and dove into them, and I couldn't see them on the charts. I got frustrated. I'd see them, but then they'd be in the middle of the chart, not on the right hand side of the chart. So I was frustrated and angry because I'm missing all these great trading opportunities because I didn't see the pattern on the right side of the chart. That's where that whole thing was born, out of my own frustration and inability to recognize the patterns on the right side so that I could take advantage of the opportunity that was there. And as I started to put that tool together, it originally was just flashcards because that's the tool, to train your brain, to train your eyes to see them. That was the tool that made sense. Right? When you're a little kid, you do flashcards with 2 plus 4 is 6, right? And at first you're counting on your fingers, and then after a while you see it, it's memorized. It's just ingrained in there. And today, when you see 2 plus 4 on a paper, your brain doesn't even turn on. It's there. You know it. You don't have to think about it. That's where I wanted to be with patterns. That was the whole purpose of the flashcards. So I built those first, and then realized that You know, if you don't know what to do with the pattern once you recognize it, then so I started putting together videos about the patterns, and I realized as I started with the head and shoulders, if you don't understand the basics of technical analysis, you're really not going to comprehend the head and shoulders that well. And so I created the foundational videos, the basics of technical, so that you could fully understand the patterns based on literally the foundational technical information that needs to be understood. So it went backwards. You know, it should have been the basics first, then patterns, and then flashcards. But I literally built it backwards. So, but it worked out. You know, hundreds of people have had it, maybe a couple thousand. I'm not even sure how many people have had it. I mean, it's been out for a decade. Uh, might be 1,000 or two. I don't know. But if you need help with technical analysis, or if you want to improve your skills, technical analysis, that is a tool you want to look at. Weekly Whispers is just my that's the analysis I do every week. I don't know, 2 or 3 years ago I went to Rob. I said, hey, I'm researching all my patterns. Why don't I just put together a video and here's all the patterns I found. Here's the trades I'm looking at for this week, and here's my trading plan. So it's essentially what I'm doing for the week. I record it once a week with all my analysis. I do a midweek update, and here's where we're at. Here's where things are at. Here's trades that are on, adjustments, whatever we do. So, and then small accounts, big return is another class I did. It's recorded now. It's been a couple years ago. Maybe it's been 3 or 4. It's crazy how fast time flies. I would say a year or two, but it's probably been 3 or 4. But it's a pre-recorded class you can get anytime you want about small accounts, big returns, right? So we all want is big returns, right? But the important thing to remember, and it took me a long time to figure this part out. Part of the reason I like doing this is taking the wisdom that I've learned over 25 plus years and passing it on. The one thing I didn't focus on in the beginning because I was so enthralled with the potential profit that I never really considered or focused enough on risk. Now the only thing I care about is risk. I don't worry about the risk reward calculation part is important, but I don't really think about the reward part. Those are going to happen, right? All trading is a 50-50 shot. You get into a trade, it's 50-50 whether it goes up or down. We don't know. We can analyze and try to figure out what might happen next based on past history, right? But there's no way of knowing with certainty. Nobody has a crystal ball. It's easy to say that. It's a lot harder to break that mentality because what we do is we look at something, we analyze it, we think this and this and this might happen, and then it does happen, and then you beat yourself up, or I should have done this, I should have done that. Well, yeah, you should have. And if you would have done that, you could have made a bunch of money. That's the woulda, shoulda, coulda syndrome, right? It's easy to see after it happens. Just like sitting there watching Wheel of Fortune, right? You're sitting in the comfort of your own house, screaming at the guy on TV, going, hey, it's this. And you can't figure it out. You can't figure out the puzzle because he's got bullets flying, right? When you're under pressure like that, your mind doesn't work like normal. It's the same thing in trading. It's easy to see after the fact. And even the times when you can't recognize the puzzle on it. And then they say it afterwards, like, oh, duh, how did I not know that? Well, because your mind didn't go there in that moment. It's the same thing in trading. You don't see it until it happens. And once you see it, you think you're dumb for not seeing it and not taking advantage of it. And it's like, wait a minute, what? But you got to remind yourself constantly that there's no way to know what's coming next. So it's always a 50-50 shot. But when you focus on risk, the reward will naturally take care of itself. If you blow up your account, or if you lose half your account or 75% of your account in one stupid trade, that not only has a massive financial impact that is hard to overcome, the emotional impact is usually more severe than the financial impact is. Money can be made back again, but the impact that it takes from an emotional standpoint, the ability to get back in the game and pull the trigger again is very, very difficult if you've taken a hit like that. So preservation of capital is important, and that's why risk. If you focus on risk and make sure that you don't lose your capital, you will get the wins. They'll come. You just got to make sure you don't blow up your account first, right? I've done it before. That's how I know. A couple of times, actually. Most traders have. Actually, I don't know a single trader that hasn't blown up their account before, or at least put a massive, massive dent in it. There's only one that I know of that didn't blow up their account, but had like a 50 or 60% hole in it. Everybody else, at some point in their trading career, has blown up an account. So the goal, your focus should be on managing your risk well. and managing your emotions well. If you do those two things, everything else will take care of itself. Right? But what we're going to talk about today specifically, though, is a color. Now, many of you have probably seen this already, right? You may know what it is. But the biggest thing, in my opinion, for this, the reason for this, especially when we have a market that is uh, inflated, many people are calling it a bubble. I would concur with that. Bubbles can go on for a long time, just like when you're at the fair, right? And you have the little gun game, you squirt the little water beam into the thing, and whoever blows up the balloon first wins. Well, that balloon can stretch a long ways before it pops. And sometimes we're like, mine should have popped already, but it didn't. And then somebody else's pops and you don't win. And you're like, I should have won. Woulda, shoulda, coulda, right? Um, so I think we're in a bubble, but it might take a while before it bursts. It might keep running for some time. I mean, it is today, right? Looks like we're hitting all-time highs on everything except for the Russell. Unless that, I don't think we hit that, did we? That's an intraday high. I'm looking at the intraday chart, but I don't think we've hit an all-time high on the Russell. Pretty sure we haven't. Visually, it doesn't look like it. But the other markets are hitting highs. So what happens and what do you do? You don't want to sell out and miss more upside, right? But you also don't want to give back all your profits. What if you could have the best of both worlds and cover both? And that's exactly what a caller will do for you. So, and this is the tug of war that we all have in our own minds, right? It's the fear. I call it, it's fear and fear. It's fear and FOMO is what it should be. I think the greed part is just FOMO. It's not, I mean, we call it greed, but all it is fear of missing out on more upside or for fear of missing out on a trade. So it's all rooted in fear, being scared of missing something or being scared of losing what you already have. So if you're afraid of giving up your gains, and you've probably all experienced this, right? Where you get out too early and then it keeps running. And then other times where you've hung on to something too long and then your profits go away. So you have there's that mental tug of war. You have this little guy on each one of your shoulders screaming at you, going, get out, get out. Remember last time? You gave back all your money. You were up $2,000, and the next day you were down 1,000 because you didn't get out and you should have gotten out. The other guy going, yeah, remember that time you were up $2,000 and you got out and you missed out on $3,000 of upside. You could have made 5 grand. You only made two. You're a moron. What are you doing? Right? Anybody else call themselves names? I do it all the time. It's not abnormal. Don't feel weird if you're doing it because you're not weird. You're just like everybody else. What an idiot. I'm such a moron. Why did I do that? And that's a whole other subject, which I've been talking about more lately just because it's so important. You've got to be careful of the conversation you're having in your head. And it's okay to call yourself a moron, but flip the coin over and make sure you look at the other side of that and recognize that you had no way of knowing that what was going to happen did happen. Just like O'Reilly. I got out of O'Reilly the other day with a tiny little profit. When I say tiny, I'm talking 5-10%, which in options trading is tiny. It's basically break even. But they were coming out with earnings, and I'm like, I'm not going to take the risk that this thing goes crazy to the upside. I had puts on it. And of course, it tanked yesterday and hit my target, my 4-to-1 target. And I was tempted to leave a small part of the position on just in case. But I decided, you know what, I'm not gonna take that risk. I'm just gonna get out of it and wait and see what happens. And then of course it tanks, boom, would have made a ton of money, probably 50, 70, 80, 100%. But I also didn't want to take that risk. So I had to balance that out. And a lot of times I'll balance it by doing that is leaving just a little bit there. I've had a couple of those recently. Nike was one of them. Some of you may have seen me talk about the Grand Slam trade that I call it in earnings season like this. I'll just briefly tell you what it is. It's not anything fancy. It's just if you know earnings is coming up in say a week or two or three, and there's some kind of pattern that's there, there's some reason to get into a trade, right? You don't just do it just because. But if there's a reason to get in, like it might move, if it looks like it might move big enough to get into a multi-contract position and then take out your initial capital. So let's say you put $3,000 into a trade, you buy 10 contracts at $3. If you can get out of say 8 of those contracts and collect 3,200, there you go, Brenda. There's one of them. and you collect 3,200 back out of the trade. You initially put 3,000 in, you sell 8 of the contracts for 3,200, you've got a small profit. And then if you are willing to take the risk on those other 2 and hold them over earnings to see if it moves, which was the original goal with O'Reilly's. That's what I wanted it to move big enough where I could get 80 or 90% all of my contracts out except for maybe 1 or 2. And then hopefully it moves big in my favor. And then you get a grand slam, right? Does it always work out? No. In fact, I just bailed on this one. Nike, I did the same thing on. That one actually worked where I got out. I got all my capital back in a small profit, and I left. I think I had 1 or 2 contracts left. This is a few weeks ago, but and then they came out with earnings. I had puts, and it gapped up. It was like, well, that stinks. But everything that was left on the table was all profit. The options went from $3 or $4 or $5, whatever they were, down to $1. I held on to it for the next day, and then I was like, there's 50, 60 cents. And I'm like, well, it's all gravy. It's all profit from here anyway. So I'm just going to take it out and get it off the table. And of course, 5 days later, it went down to like 60 or 65. I would have had $6 or $8 out of it. It was like, but right, you don't know. You don't know in the moment what's going to happen next. So the best place to get to, and that's the Grand Slam trade is one of them. And I've been doing more of that lately where not necessarily that particular trade, but get into a trade and pull out as much as possible, preferably getting risk off the table, banking profits as it moves in my favor. And that way I can breathe easy and not have to be worried about, okay, I've got some gains on here, right? You're afraid of giving up your gains, but you also don't want to miss out. Well, by scaling out in this case, then you're banking some profits, you're getting risk off the table, and you're dramatically increasing the odds of coming out with a net winner. And it will give you the opportunity to have a potential big gain. I mean, Verizon's another one that I've only got 1 contract left, but I had a multi-contract position. I've been peeling it out, and it just tanked the other day. And I'm like, cool. Everything I'm making now is gravy, and it's got earnings in a couple of days. I actually think I have 60 or 80% return on the other part of it. And so no matter what happens with this 1 contract that's left, if earnings comes out, they get absolutely hammered, then I'm going to kill it. If they don't and they pop to the upside, then I'll give back some profits. But I still have a profit no matter what. So it's however you can figure out how to do that, whether it's scaling out, scaling in, however you manage it so that you can stay in a calm, cool, collected place. That should be the ultimate goal as a trader, is to be in a place where you can stay calm, relaxed, keep your head cool, and make decisions that are good, not decisions based in emotion. Because usually when you make emotional decisions, they don't turn out well. Right? Sometimes they do, but most of the time they don't. So, just a second. Get that cough out. Not as bad as last night. Last night in Trade You, I did like 5 or 6 times I had to stop and cough up a lung. So the caller is, if you already own a stock. Now, you don't necessarily have to. You can do a caller out of the gates. And we'll look at that once we get, I'm going to try to buzz through this, and we'll go look at a real life example. But generally speaking, you already have a position in a stock, right? And you're essentially buying a put, an insurance policy, if you will, and then you're selling a call, which could, and in this case, what we're going to look at multiple different things, but the goal is to generate enough money off the call to pay for the put. That's kind of the standard caller. Again, you can tweak it however you want. There's no rhyme or reason. It doesn't say you have to do it this way or you have to do it that way. You can do all kinds of crazy, wild things, and I do sometimes. I like to do that. It's worked out well in the last few, not callers, but I just recently realized that a lot of these big, high flying, volatile stocks I don't like to trade, mainly because of the risk. Right, the risk on a $50 or $100 options for 1 contract can be huge. And I've been on both sides of that coin where, it goes in your favor and you make a killing, but if it goes against you, it's like, and even though I like to trade aggressively, I also don't like to take wild and crazy risk. So I found a balance between the two where I can trade the high flying risky stocks, but without all the risk. And one thing I'd forgotten about because I haven't done one for years, I'd never been a huge fan of spreads, but a debit spread though, this is why she's going bye bye. Say goodbye, Brenda. Bye bye. She hits the keyboard. That's a problem. I don't know where I'm even at here. She's nice, but can get obnoxious too. Um, she's persistent, so she'll be back in a few minutes. Just watch. It's like they just wait till I'm working, and then they kind of. I'm sitting here for hours a day, and then 1 hour I'm here, and they come bother me. Where was I at? What was I saying? Get irritated. I don't remember where I was at. We'll just keep going. Um, oh, the debit spreads. So, and I was poking around with MSTR because I looked at it, and there was a nice pattern on MSTR, and I'm looking at it going, and if you know it, it's basically a Bitcoin play because it's what's his name? The guy that started the company, and I'm starting to think I've seen some things about him recently that are like, yeah, it's sketchy. It was a software company, MicroStrategy. Right now, it's just strategy. It was a software company. They were almost bankrupt, and he's turned it around into this. It's basically a Bitcoin holding company. They were like 50 cents or a buck just 3 or 4 or 5 years ago. They were a dot-com bubble stocks, and they almost got destroyed. They essentially went away, and then Michael Saylor, that's who it is. Um, yeah, I saw something recently that he did some sketchy things several years ago to keep the company alive. So I don't know. We'll see how it all plays out in the long term. But anyway, it was looking bearish, and the options are like 50 to 100 bucks a piece. I'm like, there's no way I'm buying puts for that. And I was like, why not do a bear put spread? Because I'm looking at it going, this thing has the potential to go down to 250, and I think it might because Bitcoin's been getting beat up, and it's essentially a proxy for that. Um, so what I did was looked at I think it was the 280, 275 bear put spreads. The stock's up at 330 or 350, and they were a buck and a quarter around there. I put an order out for a buck and a quarter. And because I hadn't done one of those for a long time, I was just testing it. So I just did 3 contracts. So it's only 375 bucks. So it cost me $375. So I ran the math real quick. Okay, how much do I need to sell the other two of them for? Well, here's the beauty because of risk reward, right? I don't like that's the only reason I don't like debit spreads because you're collecting a dollar and you have $5 of risk. I'm not a huge fan of those. Even though you have a 70% chance of profiting on those, the risk reward just tweaks my mind. But if I'm paying a buck and a quarter for an option and I have the potential to make five, that's more than 3 to 1. So I ran the numbers I just got 3 contracts. If I can sell two of them for $2 a piece, I paid 375 for these. That gives me 400 bucks back. So I threw a GTC out there for $4 on two of the contracts out of the three. So I'd still have one left, which still leaves me $5 of upside. Right? If I get those two hit, right? This is if it goes in my favor and it moves big enough, and it's got to move big. This is one of those. The way I did it, it would have to move big, and MicroStrategies does move big, and it did. About a week later, it hit that. Maybe a few days, but it was about a week, maybe a week and a half. It hit my order for $2. So I'm like, cool. I paid 375. I just collected 400 bucks. After commissions, I got $20. I can go to McDonald's. Woo! But now I have one contract sitting there that if this thing, and it's out to December, right? So it's still 6 or 8 weeks out. And I started this about a month ago, 6 weeks ago, maybe. So I had 2 or 3 months of time. But all I have to do is sit and wait now. And if nothing happens with this, if MicroStrategy goes crazy to the upside, I haven't lost anything. If it does drop off and it goes below the strike price, then I'm making 500 bucks. So at this point, I have zero risk other than the money that's sitting there that I could take off the table and bank it, right? So that is a risk. But compared to what I started with, I have no risk on the table. And I have the potential to max out at $500. And lo and behold, guess what happened? It was the next day or a couple of days later. Sure enough, MicroStrategy pops back up. And I went and looked. I was like, you know what? These are back at a buck and a quarter. So I took those two I had sold. I reloaded those for a buck and a quarter. I put an order out for one of them at 250 because that's all it cost me for the other two. And that ended up hitting a couple of days ago. So now I've got 2 contracts there with $1,000 of upside, and I have zero initial cost. I don't have any money out of pocket, and I have 2 contracts sitting there that if MSTR is below 275 at the third Friday of December, then I'm going to make $1,000. Now I'm not going to wait for that. I have a GTC out for both of those contracts that if it hits 450 to close them out because they come out with earnings next week, I think. And if their earnings are bad and they go down, the odds of those things triggering are pretty good, which makes me $900. So why am I going to wait for another 6 weeks or so to get an extra $100 when I can bank the 900 right now? So you see, it's not. It's about for me. It's about getting risk off the table as quickly as possible, and that's the point. So I know sometimes I get off topic, or it appears that way, Brenda. But the point is to get to a risk reward that is favorable, preferably zero. I mean, do I have money on the table with MSTR? Yeah, there's money there. I could cash out and bank it as profit. So there is technically risk there, but and this is all how you frame it in your own mind. From what I initially started with, what I initially invested in MSTR in those two different trades, I don't have any money out of pocket. So I'm not concerned with what happens with MSTR, which is the goal of the caller to get to a place where you're not concerned about what happens next. You buy a protected put, sell a call. Oh, we were already past that, right? So here's a basic scenario, right? You bought 100 shares of a stock at $100, now it's at 150. You buy the $140 strike price. That's your insurance policy, right? You sell a call at 160. If the stock goes below 130, you can exercise your put, sell it at 140 and say, I'm good. Still got a 40% rate of return. Stock goes above 160, they're going to take it away. And you're locking in a 60% profit. So you're literally locking in either a 40 or 60% profit without costing anything. Outcome number 3, which I'll show you here in a minute. Stock, say, drops to 100. You can sell your put. Well, you could exercise you're right. You have the right to sell it at 40. You could exercise that right and sell it at 140. Or you could sell that put for $40 because there's $40 of intrinsic value there, right? And then go buy more stock. Use that money you made on the put to go buy more stock, which, depending on your situation, right? If you've had a stock for a number of years and you're going to have a long-term capital gains, that may be the option you want to take. Now, if you're just trading short-term, okay, that's different. But there may be tax consequences that you want to avoid. And there's ways to do that. You just have to either know how or figure out how. Uh, so yeah, I mean, to recap, it's a smart, disciplined way to manage the risk and reward if you're in a position that you're already profitable on. There are ways to do it. You can do a call right out of the gates. You can buy a stock and call it immediately if you want to, which is not a bad move. I think in this market, that's part of the reason I thought this was a relevant topic. In a market where you're afraid of a bubble and you're scared to get into a stock because what if it gets hammered? What if we are in a bubble? What if something happens? What if a black swan shows up? Or a white swan. There's people talking about white swans. I hadn't heard of that. And I'm like, white swan? Yeah, it's a normal swan that you can see coming. Black swan's an event that you don't see coming. It's a surprise. I mean, COVID was a black swan, mostly. Not 100%, but I mean, 9/11 was a black swan for sure. You don't know that's coming, right? So you can start off with a collar if you want to. You just have to figure out how to do it. You just got to run the numbers and look at it. So, but number one is it protects your downside while protecting your profits, and it allows some upside depending on how you structure it, right? It helps. I think the biggest one is it helps to remove the emotion, right? Because if you have a stock right now that you've been holding for a long time, and maybe you've endured some of those big drawdowns, which are no fun, right? If you have a stock you've owned since 2000, 2002, 2005, anywhere in there, and you went through the '08 crash, you saw all those profits go away. Well, if you'd like to avoid that, if we are in a bubble and we do have a massive drawdown like that, a massive crash, you don't want to go through that again, right? Emotionally, you remember what it was like. I know people that endured it. I was there. I didn't have any long-term positions. I was trading. So any questions on that at all? If you do, what's going on here. Come on. There we go. Yeah, if you have any questions, you know how to get in the chat box, right? No, I saw one last night. Somebody sent one in the question things, but in the chat box, I should say, not chat bot. What's AW? What's AWS? Oh, I got you. Okay, I thought you were saying I was off topic, which I kind of was for a minute, but yeah, I know. I know. Sometimes I veer off topic, and then I have a point usually. So those are the squirrels that I like to find. I get over here, and it looks like if I'm off on the rafters, and then it's like I actually usually have a point to it. So, uh, AWS, is that a company or the only thing the first thought I had with AWS is Amazon Web Services. That's the only thing I know as far as AWS. Oh, that's probably it then. If there was a major crash, we're not talking about a stock crash, right? We're talking about a crash in a server. Because yeah, AWS is I think they're the biggest in the industry as far as their servers. So they have all the technology. That's what they built to run their platform, right? And then they also sell it to that's where they make all their money actually. Because Amazon's not down. It's up $3 today. In that yeah, that's AWS's cloud service basically, which they sell to other companies. So that, like I said, that's where they make their money. That's where their profits are at. They only make their net profits on retail is like 1%, which is terrible, right? I mean, you $50 billion a year and you're only making what's that, 50 million, 500 million, 500 million off of 50 billion. A 1% margin is terrible. Retail's always had terrible margins, net margins at least. Now, Amazon's is one of the worst because of their overhead. But most retail's like that. That's why they have to have huge volumes. But yeah, AWS, it sounds like that's what it's referring to, Amazon Web Services. So, which again, I think was the genius of Bezos. He builds out this retail website that originally started with books, and then he saw the future of servers coming and I mean, cloud and all that other stuff. And it's like, if you're already building it for your own company, why not build it out so that other companies can use it and sell it to them as a service and make profits off of it? It's like you're building it for yourself, but let's monetize it and bring in revenue off of that as well. It's genius. It really is. So, but what we're going to look at today is Google. We could probably look at just about anything realistically. But this is one I was trying to think of something that's at all-time highs or near all-time highs that has run quite a bit. You can see here that it has. And actually it's only I don't know if that's right. Has it only been public or is that since they changed the ticker? I mean, have they only been public since 14? Seems like they've been around longer than that, but maybe not. So you can see, I mean, if you bought this thing anywhere before, well, realistically, anywhere before about, 150 bucks, excuse me, even if you bought it at 150, you're still up $110. That's what, 60 or 80%, something like that. Pretty solid. But if you bought it back in here, and there was a split, but, split adjusted, your cost basis is 50, 60, 70, 75 bucks. If you still own it, you're at 261 and this run, and you can see, I mean, these runs do not last forever. You can see this run here. In fact, I'm curious now. We were doing this last night, playing around, looking at percentage runs. And this is weekly, so that's 86 weeks. It's at about a year and a half. It's up 180%. That was a pretty big run. Let's see what today's is. 29 weeks, it's up 77%. So that's about 35% of the time, and it's up almost half as much, which is the point. You look at how steep that run is versus this one. This one back here in 19 and 20, there's the COVID crash. We had some healthy pullbacks along the way. So, we can sustain an 86-week run for 180%, even though it's steep, but you can see it's still going to correct at some point, and it did. 22, we went into a bear market, and in 50 weeks, we corrected 42%. So these kinds of big run-ups like this don't last forever. We could theoretically, I mean, if we went to 180%, the same as this one, and we have another 100% to go from here. So that's possible. I just don't know how likely it is. And here's the other way to look at it too. Again, the first thing is to analyze the stock, whatever it is you're looking at. If we go to logarithmic scale, log scale, it's called log scale for simplicity. You see how that changed? So here, this is static, right? So there's $25 increments on the y-axis here. So each of those moves are 25 points. But if we go to logarithmic, it changes it to percentages. So the picture is a percentage basis, not a static number, which looking at longer term charts is the way to do it because it's not, it looks parabolic when in reality, on a percentage basis, it's not. But here's where it gets interesting. I mean, we could easily draw this trend line from down here and say, there's the long term trend. We could even put one up there and say, well, there's a little bit of a floor right here, which that's kind of a valid line. But excuse me. On a longer term like this, I think the wiser moves take a mean regression line, start from the very beginning to go all the way up to today, which if you're not familiar with mean regression, it's basically taking the mean of each day and calculating it, and it plots the line. So from the very beginning of Google at 2780 up to $261, it takes each of those data points, plots the mean on it, and then gives us a straight line. You don't have to understand all that stuff, and I don't even understand it that in depth realistically. But what I know is that is the mean price. That middle line, that big thick blue line, that's the median mean price that Google trades at. And what's important to recognize here is that you notice it doesn't get too far away. You got the lower lines, which I think are 2 standard deviations, if I remember right. Which, if you think of a bell curve, and I don't want to get too mathematical because I'm not that mathematical myself, but you think of a bell curve, right? 95% of, I think it's, see, it's the thing. I don't know what that in depth. Okay, one deviation, I think is 60%, so 30% on each side, and 2 standard deviations goes out to, it covers 95% of the bell curve. So you got 5% on either end, 2.5% here, 2.5% here, that are the outliers, right? They're the extreme. 95% is within 2 standard deviations of the mean. So you got the middle line, and 95% of the average lies within that 95%. Hopefully that makes sense. If not, don't worry about it. It's not that big of a deal. I'm going a little bit math nerd here, even though I'm not a math nerd. But the beauty is, if you have just a basic understanding like I do, you can see then visually that this thing, once it gets down to, outside of the normal range, like it did here, it gets to an extreme. Because again, this is the mean. When it gets way out in the extreme, gets out to that 2 standard deviation line, then it usually reverses in relatively short order. And we can do the same thing here and look at, how far does it move away from the mean. So there's the mean, and we do this percentage move. So there's 17%. This time here, it's, that's the COVID crash right there. 27%. You can also go the opposite. And this is back, 17, 18. When, we got to take into context the years that we're in too. Looking back historically, at least, do an analysis because you go, okay, what is the time frame? We were just in kind of a regular old-fashioned bull market here. Nothing crazy, nothing high, nothing bubbly. We didn't have .com, we didn't have AI. Well, the COVID crash, this makes sense, right? We were up about the mean, and it crashed down way down to the end because we had a massive crash, right? For 4 weeks, we just got hammered 30-some% in the market. It bounces back, and well, there's that rally. I don't want to do that one. We're going to go from here, where when it got back to the mean, and it rallied from the mean, it ran 68%, and that got way outside the mean, right? So that was not normal. So it's outside the range. So realistically, once we get up into that higher end of the range, the odds become higher and higher that we're going to have some kind of pullback. This is the bear market, right, of 22. Took 6 weeks, 20% it dropped. once we got into the bear market, and it almost overcorrected, right? It dropped here from the mean down to way below the mean, but below the two standard deviations in 11 weeks, 25%. So we dropped, what was that whole drop there? I thought we looked at that earlier, but I don't remember. 42%. And you can see where we're at now, right? Again, a lot of this is just looking at going, where are we at now relative to the mean? And we're here. We could realistically, if a run like this continues, we could realistically keep going and run another up here. No, not sure how far that might go up, but let's just duplicate that line right there and see if we can do that and run it up here. And I don't know if I didn't do this earlier. I was playing with this earlier a little bit, but what is it? What's the number again? I'm not going to worry about the number of bars. I don't care about that. 68, that's close enough. 68%. Well, wait a minute. That's from the mean. Which just might not be a bad idea if you're looking at color in a stock that you already own, like Google. But 68, 66%. Okay, so that it has the potential to run up to around 330 or so. If it does what it did back here after the COVID crash. But again, you've got to take into account the time frame that we're looking back and referencing. Because you can't take, and I see some of these goofballs they're running ads on Facebook saying, we got a 90% win ratio on Apple. And they went and did back testing. And they back tested from 2001 to 2007. Well, what do you think is going to happen? If you're in a bull market and the market's only going one direction, that's all you're going to get. But if things correct and they go the opposite direction, your entire model is dead. You have to take into account different market conditions. If you're going to do modeling like that and you're going to go back test stuff, you can't just take it on a specific market condition. That's why relativity and putting things in context is so critical when you're doing that kind of stuff. I think one's class C, one's another class. I don't know. They split them up. They did it. There's Google and there's Google. I can't remember what the difference is, but for the example, it doesn't matter. So, but I can't remember. Probably grok that or Google it. Google it. Uh, yeah, I don't remember what it was exactly. It happened quite a few years ago, but I think they're copying Buffett. Where Buffett, you have Berkshire Class A and Berkshire Class B. I think that's what it was, but again, I can't remember. So, but the charts look the same, and the numbers I'm sure look the same too. So theoretically, I mean, again, based on this, going back to this. So this was the COVID. We had the COVID crash, and then part of the reason we had this massive rally was because the government just pumped money out into the system. And these 18, 19, 20, 25 year olds that were, waiters and waitresses in college, all of a sudden can't do anything. And what did they do? Hey, they're all online and all their buddies are getting on Robinhood and they're making a bunch of money. Let's be traders. And they thought that they were traders for about a year or two. And then the bear market of 22 hit, and at least the things that I've seen, they all got clobbered because they didn't know how to handle a bear market. They didn't know what a bear market was. They didn't know what it looked like. They didn't have the experience. They didn't understand at all. Just like a lot of people in 2000 got destroyed. So many people in the mid 95 to 2000 were geniuses. And then in 2000 showed up, the bears showed up, and guess what? They didn't have any bear spray. They weren't prepared. They didn't know what they were doing. So you've got to, if you're going to be a trader, you've got to understand and know both sides of the market and be able to see it from both angles and be prepared for what might come. So that is, I mean, again, if we go from, we were at the mean 68%. So there is potential to run all the way up to 330 based on this, but we'd again be outside of the mean, which means it would likely, the odds are eventually it's going to pull back. Could it go past that? Of course it could. But I don't trade on woulda, shoulda, coulda. I trade on odds. What are the odds of something happening? And the odds of Google continuing to run, especially past 3 or 330, are pretty slim. Entirely possible, very well could. So now let's take a look at the actual options. So there's the chart of it. That's about where we're at right now, I think. Yeah, 261.40. This is excuse me, tickle. This is streaming, it's not real time. as far as what you're looking at on the chart. 261, you can see the price is moving, but it's about a 15-minute delay. You see 9:32. That's West Coast time. It's actually 9:47. So it's 15 minutes delayed. But you'll see the price move because it's active there. And I'm going to grab an option chain. Oh, good. Make sure it's the right one. This thing's been goofy on me lately. Um, is that the detached tool? Yeah, there it is. Okay. Why does it do that? What do you think, Katie? That's not it. Why did it not give me my option chain? Detach. Okay, that's not the detach button. That detaches something else. So now the question is, again, this example is, let's say you own Google. Let's say your cost basis is $100 just for the math's sake, right? You're gonna have to do some math on your own. This is easy math, not mean reversion math. Let's just say your outlook is that Google might run up, maybe it runs to 300. And I can see that possibly happening. Do I think it's going to go a lot past 300? Probably not. And let's just say between, and obviously you can do this on a short-term basis, but I'm going to look at the example just as a long-term basis. And you have to do your own analysis and figure out, what you think the stock's going to do, where do you think it's going to go, and your own risk reward and how much do you want to protect and all that stuff. So I'm going to use a longer-term perspective on this, mainly because I'll give you a little twist at the end that I think could be good. I'm not super bullish on this market, as some of you maybe either picked up or you've heard me before. I think that this market's overheated. I mean, the PE ratio on the S&P is over 30 now, which the average historically is 15 or 16. So yeah, things are definitely bubblish. You've got lots of different sectors, and then you've got this. What was that? It just came up last night, and I'm drawing a blank on the name. Starts with a T. The finance company that just they finance some subprime autos, but they basically were committing fraud, is what it looks like. They were writing multiple loans on one vehicle. I don't know where the money was going or who was getting it, what's going on there, but um, they just went banko, just like SVB did a few years ago. And people were saying, "Oh yeah, this company's great. They're solid." And 2 days later or 2 weeks later, they're gone. They're bankrupt. They have no money because they were writing loans on multiple vehicles or something like that. So there's a lot of on the lending side of things. There's a lot of and obviously that's some prime auto. But when you start to look at when you dig deeper and you look at the bigger picture and you look at what's going on behind the surface, and this is another one I saw recently. Well, I guess it's been 3 or 4 months ago. Uh, Talking about the RV market. If you go back to 06, 07, especially 07 and early 08, guess what market turned before the housing market did? The RV market. RV market got super bearish. People were trying to unload RVs. They couldn't sell them. Literally were giving them away pretty much. And then autos will go next. And then the housing market goes, right? So you can look at things in succession and say, historically, this is how things have gone because an RV is not required, right? You don't have to own an RV. And if you're in trouble financially or if your income changes, guess what you get rid of? The extra stuff. I have a friend that 2 or 3 years ago, she was like, yeah, we have this RV, we have this big truck, we have all this stuff. We really don't need it all. And things were getting tight for them. So they were selling the RV. That's the first one to go. If you get in a pickle financially, you're probably going to keep paying your mortgage and you'll stop paying your car payment first because you'd rather lose the car than the house, right? So you could look at the data from these different industries, and if you can see the trend of where things are going, I just heard this yesterday that even prime borrowers are starting. The default on prime borrowers for vehicles is going up fairly quickly. I haven't seen the data on it, but I was watching something. There's a lot of YouTubers out there that put out good data. I found several that I've confirmed I can trust. They put out good information. So I go look it up and verify that what they're saying is true. So I don't have any reason to doubt this guy, but I just haven't confirmed it with the data. So make sure you do that. But um, so you've got this lender that went away. You've got prime borrowers whose payments are the average car payment is now $800 a month. Houses are, depending on where you live, right? At least where I'm at, you're about $4,000 a month for just an average house here, almost a starter house in the Seattle area. That's if you're putting a 50 or 100 grand down. So it's pretty crazy. I mean, the standard of living, you got to make 120 grand out in Seattle just to get by. In Seattle, actually, you need more than that. I'm south of Seattle, about 40 or 50 miles. But the reality is that the affordability issue is massive. So when you see things like RVs and vehicles and delinquencies going up, bankruptcies increasing. In fact, I just heard last month that corporate bankruptcies hit, I don't know if it was either a record high or almost a record high. It was even higher than COVID, which we saw crazy numbers in COVID because people had to close their doors. They couldn't keep their doors open and they had to close their business. They couldn't make it. You had bankruptcies galore during COVID. And corporate bankruptcies, I think it was last month, maybe the month before, hit either the same high or a record high. So when you dig deeper and you start to look underneath the surface and you don't just look at the stock market, because excuse me, I just heard this morning actually on CNBC because I have it running up here in the corner. They said, I think it was what was his name? What's his name? He's been on it for a long time. Rick Santelli said some of this economic data is it makes the economy look bad, but it looks like all we have to tell how the economy is doing is the stock market. In other words, the stock market is the gauge of how the economy is doing, which is ludicrous, absolutely ludicrous. Because there are so many times in history where the stock market has gotten so disconnected from the real economy. Look at 2008. The real economy went into recession before the market even crashed. The real economy gets into recession usually at least 6 months, if not a year, before a recession is even noticed. Recessions aren't called on average until a year after they actually took place. So the recession is over by the time the stock market recognizes it. The '08 crash happened after the recession happened. And the only reason the crash happened was because some of the banks, Lehman and the others, went under. And people panicked and freaked out, but then they started to look under the hood. So to make the statement, especially a guy like that that's been around for a long time. I mean, I remember him when I started 25 years ago. He's been on that long. And to make a statement like that, the stock market is the only gauge we have of the economy is insane. Insane is a good way to put it. Because the two can be disconnected. It is a good gauge, but not on the short term. And when I say short term, I'm talking about at least a couple, if not 5 years. Because the stock market is based on belief of what is coming in the future. And only when reality hits and things get bad is when the market starts to see it and they go, oh crap, maybe it's not as good as we thought. And one of the things I know is that uh, one of my relatives just got laid off. Not for another 5 weeks, but then got a severance. But also, they laid off his entire department, 96 people. They canned them all, or they got rid of their position or something like that. Supposedly, they're going to bring back 40% of people at the lower tier. So even if he takes a job, even if he takes the job back at a lower tier, he's getting a pay cut no matter what. His salary and his bonus will go down. And I talked to a lady that recently retired from Microsoft. She said they're doing the same thing. They've been doing that for a while. So they're eliminating positions and then hiring them back. And in the tech world, partly because of AI, the tech jobs are slim. I mean, I know a lady I've known for about a year now that moved up here from San Jose, from Google area, to get a job in the tech world. She still hasn't found one. In a year, she hasn't been able to get a job in the tech world. And so these people that work at Microsoft, they're getting a 20, 30% pay cut, and they're taking the job because they got bills to pay. I mean, yeah, I'm not going to make 300,000 a year. I'm only going to make 250. And my bonus will be, 50,000 instead of 100,000. So that is going to trickle into them spending less. Those are just things I've learned about just in the last couple of weeks. So, and a lot of companies are doing that. So the unemployment number may not be going up dramatically at this moment, but eventually it's going to. So getting back to this, because I just noticed, holy cow, we've only got a few minutes left. So let's say Google. Let's say we have about a year horizon. So we're going to go out to January of 27, which is only 14 months away. So you own Google and you're concerned. You think there may be some more upside, but you're concerned that it might, if the market crashes, then Google's obviously going to get dragged down with it. So you want to protect it, right? You want to have some puts in place. This is where it could get interesting. This is where the math comes in handy. And it's just basic subtraction and addition. So, but you can look at, you can either decide, depends on how you want to look at it. You want to say, okay, 240, there's a little bit, you look at a little bit of support right there, about 237. Say, okay, if it breaks that level, breaks below 240, I want to have insurance below that. So you can come over and say, here, the 240 puts will cost you 25.40. Hopefully that's the last of it. So it's going to cost you 25 bucks. Just say you own 1,000 shares. You don't want to take, it's a $20,000 hit if it goes down, which in the big scheme of things, not much, but you can buy whichever ones you want. Again, I'm just giving an example. You can do whatever you want. So let's say you're buying the 240s for 25 bucks. Well, you don't want to pay out of pocket for that, right? Especially you got 1,000 shares, that's 25 grand. So you come over to the call side and say, okay, which ones can I sell for at least $25 to pay for it? Well, there's the 315s or 25.90. So you can sell these for 25.90, take that 25.90 and go buy the 240 puts, which seems a little bit skewed to me because realistically, you're giving yourself, what do we say, the 315s? You've still got, what's that, 50 bucks of upside with only $20 of downside. And it doesn't cost you a dime. I mean, you're collecting as much as you're paying out. So you're giving yourself another 50 bucks or more upside and protecting that downside in case it tanks. Which we already established that even if it goes above, like it did last time, above that mean reversion line, 330 is about the limit on that. So let's say you want to go out there in case it does go up there. You can sell those for 22. And then if you don't want to spend any money, you can come find ones that are 22. Here's the 230s or 221 or 21 and a half. Well, actually, those are 22. Let's say you're okay spending a buck 30 or a buck 50. So you'll spend 1,500 bucks to get the 235s. So you can spend a few bucks if you want. If you want to buy the 25s for 30 bucks and then sell the 330s for 22, it'll just cost you $7 a share. So you can do it however you want. There's a million different ways to do this. You just have to do your analysis, figure out what you think is going to happen, and then figure out where you'll be mentally and emotionally if something bad happens and if something good happens. Okay, here's the possibility of an outcome. Here's another outcome that could happen. Where am I going to be mentally, emotionally, financially if either one of those happens? You take that consideration and you say, based on that, here's what I need to do. I need to sell the 330s and buy the 220s. So step one, what's your analysis? Financially, emotionally, where are you going to be? What do you need to do to protect it? Now, here's the beauty. And then you just go do that, right? The beauty is you still have upside. Now, one thing to keep in mind is even if you sell the, let's just say you sell the 300s. Let's say in 6 months, the stock is pushing 300. Well, you can always buy them back. You're not locked in. You can buy the options back, right? You can buy it to close. It's going to cost you more and then roll it out. Say, okay, I'm going to buy back if you were doing that right now, you'd buy these back for 30.80 and say you want to roll it out 20 points. You go to the 320s and sell those for 22. So that's what, $9 difference. So it's going to cost you $9 a share to roll it out, but that also gives you 30 bucks more upside. So that's a possibility if you need to. That's if Google goes up. But let's just say, and here's the other thing, I'm going to close with this. Let's say that you do it zero cost. You don't want to spend any money. So you sell say the 300. You like 300 is a nice round number, right? And this does seem really skewed because that's 1, 2, 3, 4, 5, 6, 7, 8. That's 8 strike prices out of the money. You could take that 30 bucks and come buy the 250s, which is only 3 strike prices out of the money. That seems really skewed to me. But I mean, there's a lot of time value in it, so it makes sense to a degree. But usually they'd be about equal. You're 8 strikes out here and you'd be about 8 strikes out. But so yeah, I mean, I like that. Well, there's one more idea that hit my brain, but I won't go there today. You guys can play around with this and you could run numbers and do numbers. You could just do a buy right. I mean, you could buy the stock right now at 261 and, sell 10 strike prices or two strike prices out of the money for 40 bucks, buy two strike prices down for 32, and you got $8 in your pocket and $10 of upside and $10 of downside. Anyway, but let's get back to here's the crash scenario. Here's where I think it could get really, really sweet. So you sell the 300s for 30 bucks, you come down and buy the 250s. You bank enough to go to McDonald's or a nice steakhouse, depending on how many shares you have. And let's say that Google then tanks all the way down to 200. If you have 1,000 shares, well, what do you do with do you exercise your 250s and sell the stock at 250? You could. But again, what happens if you have long-term capital gains and you don't want to pay the tax on that? Why not just sell your option? I mean, you'll have to buy back the calls, which might cost a little bit. It will cost a little bit, but it probably shouldn't be a whole lot. But let's just to keep the math easy, say, well, the intrinsic value is going to be about the same. So let's say you could sell it for 50 bucks. So you sell it for $50. That's 50 grand. If you have 1,000 shares, you bank 50,000 bucks. Let's just make the math even easier. Let's say it's 40,000. Let's say you only bank $40,000 on it. The stock's at 200, right? It's dropped off to 200 from 260 all the way to 200. You can now go buy 200 more shares of Google. You owned 1,000. You take your insurance. You did a caller. You sold the calls. You bought the puts. You bought the insurance. Now the stock dropped. You think that 200 is the base. It looks like it's building the base. It looks like it's probably going to go up from here. So you cash out your $50,000 or $40,000 of option, your put, your insurance policy, close out the calls. You exit that position, take your $40,000 of profit and go buy 200 more shares of Google. Now you just increase your position by 20%, right? So let's look at both scenarios. Let's say you do absolutely nothing on Google. You got 261,000 now. It drops down to 200. You've lost 61 grand, right? And let's say 2 years from there or a year later, it gets back to 261. So you've endured this $60,000 drop all the way to 200. Or you do a caller and it goes down to 200. Boom, you cash out your puts, you buy 200 more shares. You got 1,200 shares now, and it's back at 260. Instead of enduring the $60,000 drop and then being break even 2 years from now, let's say, you're not back at 260, you're at 312. You've added 20% extra profit to your position, to your long-term position, simply by recognizing or acknowledging and seeing that we might be in a bubble. And if we are, I want to protect the downside. And I don't want to pay for it. So I'm going to use this strategy to pay for the insurance and you might have to roll the upside. If it does keep running, then, you have to adjust from that perspective, but you can always roll it. Eventually the stock's going to drop, right? At some point, it's going to drop some distance. The question is when, how far, how big. So there's a million different ways you can do this, right? You can do this on a monthly basis if you want to tighten it up and do it on a shorter term basis. You can go out to, there's January 28th. If you're worried about the long term, you can go out and, go all the way out to January of 28 and do the same thing. I don't know why this thing's so slow and bogging down, but you can go sell it. What is this? Just out of curiosity, 2 more years. The 350s or, if you want to leave the upside more open, 350s are 32 bucks. You can buy the 230s, bank a little bit of money, and you got 2 years of time. If it goes down to 100 bucks, actually, I just thought of this. This would be the crazy time where you would almost root for Google to tank in the short term. Because if you own the 230s and it goes down to 100, you have $130 of intrinsic value. Run the math on that puppy. Let's just say it goes down to 150, which there is a support level there. But let's just say it goes to 100. And you got the 230s. That's 130,000 of profit you have, and the stock's at 100 bucks divided by 100. You can add 13. You could double your position, more than double your position. You had 1,000 shares. Now you have 1,300. That's crazy. To put on a position like this and then root for Google to tank in the short term, it's a little insane, right? Like drop to 100 because then you have all that profit on that put. You can roll right back into stock and then you have a bigger position if you're long term bullish on the stock, right? Excuse me. So again, I'm just throwing ideas out, something to think about. If you own stocks, you have to go run the numbers on them. Google's a volatile stock, so it's an example that the math works easy. Sometimes the math just doesn't work on them. Depends on what the stock is. You can go look at some really low volatility stocks, and the numbers just don't seem to make a lot of sense. In that case, you might want to do a different strategy. But on the higher flying volatile stocks, which are the ones you want to protect, right? Because they have the potential to make big giant swings. So you don't want to have that big giant 50, 60, $100,000 swing or get hammered like people do in market crashes. But you can use this as an opportunity to capitalize on the moves or if you want to do longer term, especially if you don't want to babysit it. Most of us, I'm guessing, because I'm a short-term trader, right? I don't have any I have a couple long-term positions. I guess I have 4 or 5 now, but I slowly add to them here and there, but it's not something I'm just on long termer, right? I don't do this. I'm not building a huge portfolio of stocks that I can, dividend stocks that I can retire on in the future. I might do that eventually when I get old enough, but I'm not there yet. I'm still a little bit young. Not quite, but anyway, any questions on any of that? Again, it's you can get creative and have as much fun with this as you want. You can do all kinds of crazy stuff. This is just one idea, one example of something that is possible, especially if you don't want to babysit your stock and you don't want to be, that's the reason I went with January of 27. That's 14 months from now. And there's lots of potential next year for the economy to get really hairy because employment is not looking good. Inflation just came out today. The CPI data just came out today. It's still elevated. It's still at 3%. It's still 50% higher than they want it. Yet they're cutting rates, which is, I just heard some guy say, I think yesterday or today, was this the first time they've cut rates when inflation is still high and the economic data is still relatively good. So why are they cutting rates? If the economy is so good, then why are they cutting rates? That's the crazy part. You can't make sense of that. If the economy is good, they should be raising rates. It's like this something doesn't add up. And then you look at gold at 4,000, it's 41.45 or 41, it's probably 41.30 spot price. The December futures are 41.45 right now. Gold's hitting all-time highs. It's more than doubled in a year and a half. Has nothing to do with that. This is not politics. Politics has the policy that Congress and presidents implement take time to play out. I think a lot of the policies that Trump has enacted are going to be good long term, economically speaking. Love him or hate him, it doesn't matter. But his economic policies are good long term. But in the short term, there's not much that's going to change. I mean, you can go out drinking all night long, get super drunk, and you're going to have a hangover most likely, right? You're going to be stumbling the next day like, I feel terrible. I won't say I've ever done that before. Never. But when you have cheap money and free money and helicoptering money out in the economy and you have crazy inflation, you have all these economic policies that were put into place that created this mess. It's not going to be fixed overnight. You can't just snap your fingers and have it go like that. And well, I shouldn't say most, but a lot of the economic stuff comes out of Congress and the spending that they do. That's the problem. It's not even the president. Can't blame Biden. You can't blame Trump, even though they sign it. I mean, you can to a degree, but Congress is the one who has control of the purse strings. They're the ones implementing all this stupid spending and wasting money on crap that's unnecessary, blowing money, corruption, all this stuff. And honestly, I think Trump's trying to fix it. Like, again, love him or hate him, he's trying to fix it and get rid of a lot of that stuff. A lot of the spending is just stupid. We have the same thing in this insane state. Spending money on crap. We got racist policies, all kinds of BS, but I'm not even into that. The president can try to put pressure on people, but I don't think that matters at all. People are going to do what they're going to do. And the economy, he doesn't have a lot of control over the larger economy, nor does Congress. They can implement policies, but like I said, it takes time for them to play out. They don't happen instantly. And the policies of the last 4 or 5 decades, the crazy spending, we have it's probably 38 trillion in debt right now. And that's not stopping. The interest on the debt is now one of its biggest expenditures. Go back and study history of countries that go bye-bye, that collapse. That is the point where they start to go, is when the interest payments on the debt get past, that becomes your number one expenditure. That's when there's a problem. And that's what some people are trying to fix, some people in Congress, and you just can't have it. You either have to outgrow, which is what Trump's trying to do. He's trying to create enough growth to overcome the debt and make it smaller, or you have to cut spending. It's one of those two. You either grow out of it or you cut out of it. It's one of those two. We're at an inflection point in this country where you can no longer just keep kicking the can down the road. It won't work. The entire country, the entire economy will collapse unless something is done. By Congress, the president, both, something's got to be done because it's not sustainable. Either outgrow it or cut. And realistically, it's so bad that both need to take place. So, and that's just my opinion. So, the reality is that we, as little minions, don't have any control over any of it. So, all we can do is sit back and look at it. We can argue back and forth, and you can argue your side, and I can argue my side. And as long as we can sit and have a beer together and be respectful, I'm cool with that. The sad reality is we're so divided now because it's either my team or yours. And if you're on the other team, I hate you. We can no longer have a respectful dialogue and just say, I believe this, you believe that. Okay, we can respectfully disagree and part as friends, and let's go have a beer and talk about family and friends. We've lost that. That's the sad reality. So it'd be nice if we could get back to that place. So anyway, so yeah, again, I don't care where you're at politically. It doesn't matter to me. And we don't, like I said, we don't have any control over it. So all you can do is take in the information, analyze it, figure out for you what it means for your situation, for your trading, and how to capitalize on it. Be aware of it, know what's coming, because I have very little doubt this economy is going to go into, I think we're probably already in recession, realistically. At some point, it's going to happen. It's not a question of when, it's a question of if. And being able to spot it ahead of time and be prepared for it and take advantage of it is what's key. See, a lot of people, they call me Debbie Downer. It's like, I'm not afraid of a recession. I'm not afraid of a bad economy. I'm not afraid of getting laid off. What I'm afraid of is missing it, is not seeing it ahead of time and being aware of it and being able to capitalize on it. You realize that most big fortunes are made in bad economies when things go bad. Those that are prepared for it, that can take advantage of it when it goes bad, they're the ones that create wealth. A bad economy doesn't destroy wealth. It does, except for those that are prepared for it, that can see it, the potential of it coming, and are prepared for it. And that's part of the reason I do this. I want you to all be able to see. I don't know when it's coming. It's coming at some point. But be ready for it. Be prepared for it. So when it does happen, you can capitalize on it. And you can build yourself into a place where you can be comfortable financially or wealthy, whatever you want to be. Doesn't matter to me. A bad economy is an opportunity to create wealth. And that's part of the reason I showed this is if Google tanks, let's say it drops to 100, and you can go buy more. In 5 years, if it's back to 260, you just doubled your position size without it costing you much of anything, with your loss being minimal. So be prepared for it, be ready for it, know that it's coming, and take advantage of it when it does get here. And with that, I got to shut up because now, well, we just started a few minutes late, but still I'm way over. So anyway, thanks for hanging out, having some fun, and y'all have a great weekend, and we'll see you on the next go round. All right, y'all take care. God bless. Bye bye.